is something that I really want to talk about. Um, this is a concept that a lot of people do not grasp, and I think that it's essential that you understand this concept. Okay, we're going to talk about paper gain or loss versus a real gain or loss. Okay, um, a very important note. Okay, the appreciation or depreciation in the value of a stock is not realized or it's not actual unless the stock is sold. Okay? Until you actually sell the stock, the appreciation or depreciation in value is not actual, but rather on paper. So basically, when I go and I look at the stocks that I own, in I usually do my trading with ShareBuilder, and when I go in there and I look at my portfolio, I look at the different stocks that I have, and it shows the amount that I paid for it, and it will show what it's worth now at this present moment, what it's worth, and then on another line it will show me how much I've gained versus how much uh, I, I've lost since I've invested in that particular stock. But unless I actually sell the stock that I own, it's not actual. So yeah, it can show me on paper that I have a $200 gain or $200 profit on a particular stock that I bought 5 years ago. But unless I sell that stock, it's just on paper. This is very important for you guys to understand. Okay, so let's just look at a quick example here. Let's say that you bought shares of Apple Incorporated, Apple Computer, for $30 per share in 1990, and in 2010, the market value of Apple shares is $25 per share. So that's basically like a $5 um, drop in the amount that you paid for it originally. And so you paid $25. Uh, you paid $30, but the current value right now is $25. So this is showing basically a loss in value of $5. And if you do not actually sell your shares, then this will just be considered a paper loss. Okay. Um, if you do sell your shares, then you will actually lose $5. And once again, this is very important because I've had a situation where um, a good friend of mine he actually invested in Apple, and he purchased stock in Apple for like 50 something dollars. And Apple was going through some hard times, and the market value of the price of the stock dropped to about $14 a share. Okay, so if you look at that, $50 minus $14, that's $36 that this guy has lost. But it's on paper because he said, "Hey, I'm not gonna sell it. I'm just gonna hold out for the long term." And now that particular stock is trading above 200. I'm not sure exactly how much Apple is trading at, but I know it's over $150 dollars per share. So he held out for the long run. But initially, like people will get scared of that when they see, wow, I bought the shares for $50, but I, I, it's now worth $14. Oh, I need to get out of this thing. Why get out? Hold on, try to get some of your money back, and then you sell. Okay, we'll talk about that in later lessons or whatever. But let's go on to the next example. Okay, let's say that it was in reverse. You bought shares in Apple Computer for $20 per share in 1990, and then in 2010, the market value of Apple shares is $30 per share. So it's an increase in value. Okay, so the current value is $30 per share. You pay 20 for it, and it's appreciation of $10. Once again, if you do not actually sell your shares, then this will just be considered a paper gain. On paper, on your bank statement, it just shows that you have a gain of $10. But um, until you actually sell a stock, then you will not get a actual cash. So basically, what will happen is, yeah, you paid $20 for your shares, and when you do sell it at its current value of $30, what you'll get is $30. So you made a profit of $10. Looking here, it says $5. That's a mistake, but I'm sure you guys can. But once again, this concept is very, very important to understand. Um, I think this is one of the main reasons why a lot of people are so hesitant into getting into the stock market. Um, Me personally, as an investor, um, I'm a long-term investor. I'm not a trader. I'm not a day trader. I find good companies to invest in, and I invest in them for a long haul. And one of the things that that's one of my rules of thumb, um, with with regard to investing, is that if I know a company is going to be around for a long time, then my stock is always going to have some value to it. Okay, unless a company goes completely goes out of business and stop operating, then then your stock will always be worth something. So this is a very important concept to understand. If you have any questions, please forward them to the email, to my email, or open up a ticket at the